Until a few months ago, Amazon and Flipkart were my go-to websites for online shopping. But then my wife introduced me to Meesho. At first, I couldn't believe the price points at which products were being offered there. I doubted whether the products being offered were of optimum quality. To find out firsthand, I ordered a couple of items. Honestly, my overall experience of those items was rather mixed. But since then, I've started using Meesho, especially to compare prices with those of Amazon and Flipkart. So when I found out that Meesho was going to come up with an IPO, that piqued my interest. How does Meesho manage to offer products at such attractive prices? What is the business model? Is it sustainable? More importantly, is this IPO a chance to ride the next wave of Indian e-commerce growth? Hello and welcome to ET Money's YouTube channel. Today, we will analyze Meesho's IPO so that you can decide whether or not you should invest in it. The company is raising 5,400 crores. The IPO opens on Wednesday, December 3rd to Friday, December 5th. Now, like our other IPO videos, this video is divided into certain sections for ease of understanding. Now, if you like to watch our other IPO videos, we have compiled them in a playlist for you. The link is in the description. Alright, let's begin by taking a look at the key IPO details. The key details of Meesho's IPO are on your screen. The total issue is about 5,400 crores, of which 4,250 crores is fresh issue and about 1,100 crores is offer for sale or OFS. Now, in a fresh issue, the company raises money by issuing new shares, and in an OFS, existing shareholders sell their shares to the public. The IPO opens on 3rd December, Wednesday, and closes on 5th December, Friday. The lot size is 135 shares, so the minimum investment at the upper price band is about 14,985. Now the promoter holding will come down from the existing 19.1% to 16.8% post the IPO. The promoters Vidit Atre and Sanjeev Kumar are taking part in the IPO, and the offer for sale is mainly from early stage investors and private equity firms. Alright, let's now take a look at the company's business and industry. Meesho operates as a technology-driven, asset-light online marketplace where sellers list products across various categories, including apparel, footwear, kitchen appliances, beauty, personal care, and more. Now, when it comes to market share, Meesho holds around 20 to 25% in the fashion and kitchen segments and around 8 to 10% in the beauty and personal care segment. Most importantly, Meesho does not buy products, does not store inventory, and does not run warehouses for stocking goods. It acts as a platform that connects buyers, sellers, logistics partners, and content creators. The company has two business segments. First is Marketplace, which is the core engine of the company. This is where Meesho earns money through order fulfillment fees, logistic income, and advertisements. Notably, the company does not charge any commission to its sellers. Now, this allows its sellers to keep their costs low, and those low costs are passed on to consumers. Now, zero commission also encourages more sellers to list on Meesho, which further enhances its appeal to customers. Now, the second business segment is called New Initiatives. These are early stage bets such as local logistics network and digital financial services offered through partners. Now, as of 6 months ended September 2025, the marketplace segment contributed to 99.9% of the revenue. The New Initiative segment is growing, but as of now, it doesn't contribute much. Finally, in terms of adjusted EBITDA, the marketplace segment contributed 95%. However, both these segments are currently loss-making. So, this was about the company's business. Now, as far as the outlook for the retail industry is concerned, the total addressable market, or TAM, is expected to grow up to 135 lakh crores by FY30 from 83 lakh crores currently. The interesting part is that Tier 2 and Tier 3 cities, where the majority of Meesho's audience resides, may witness a 12 to 15% annual growth. Now, within the retail industry, the e-commerce segment is experiencing a very positive momentum, with an expected annual growth rate of 20 to 25% until FY30. These factors collectively suggest healthy growth prospects for the company. Alright, next let's take a look at the company's financials and valuations. But before that, if you have been finding this video useful, do subscribe to this channel and don't forget to press the bell icon so you never miss a video from us. Let's take a look at some of the key financials of the company. Now, over the last 2 years, the company's operating revenue has risen from about 5,700 crores to near about 9,400 crores. That's a growth of 28% per annum. Even other income has also increased from 163 crores to 511 crores, and that's a growth of 77% per annum. However, investors should be aware that this huge jump is due to interest on bank FD and accounting adjustments like fair value of estimation of investments, provisions written back, etc. Now, the key point is that they may not sustain in the future. Moving further, the company is loss making and posted a loss of nearly 4,000 crores. However, do know that it is impacted by one-time exception loss of about 1,300 crores and one-time taxation of about 2,400 crores for restructuring and merger accounting. The company's loss before exceptional items and tax for FY25 stands at 108 crores. That's actually lower than the FY24 loss before exceptional items and tax of 315 crores. Now, the company managed to report a positive operating cash flow of 539 crores in FY25. The company has been debt-free, and that's a positive. Now, its EBITDA margin and return on equity are negative. Overall, the company's revenue growth is good, but profitability conversion is poor. Next, let's take a look at some key performance metrics. First is net merchandise value, or NMV. Now, NMV is the monetary value paid by consumers. Over the last 2 years, the NMV has grown by 25% per annum. Then comes placed orders. They are unique orders placed per transaction, and they have grown by 34% per annum. Finally, the annual unique transacting consumers have also grown at a healthy rate of 21% per annum and stand at 20 crore. Overall, the company's performance metrics look quite promising. Finally, let's check Meesho's valuations. For new age tech stocks that have yet to demonstrate sustainable profitability, a useful metric is price to sales or market cap to sales ratio. At the upper price band and considering the post-issue share count, the company's market cap comes to about 50,000 crores. Now, this market cap divided by FY26 extrapolated sales of about 11,000 crores gives us the market cap to sales ratio about 4.5 times. But to know whether it's high or low, it needs to be compared with the market cap to sales ratio of the company's listed peers. At 4.5, Meesho's market cap to sales appears to be on the lower side. This brings us to the next section. In IPO investing, it isn't sufficient to evaluate the business and financials. One must also pay attention to certain IPO related metrics. We discussed them in our video on analyzing IPOs, so you can watch that video to learn more. In that video, you will also find 5 IPO hacks to increase your odds of success in IPO investing, so do watch it. As always, the link is in the description. Okay, let's now discuss the red flags in Meesho's IPO based on those metrics. First, the company's promoters, Vidit Atre and Sanjeev Kumar, are taking part in the offer for sale and are thus selling part of their stake. Now, if the promoter of a company is reducing its stake, that doesn't inspire confidence. Second, around 480 crores of the 4,250 crores fresh issue will go for the payment of salaries. So, in a way, this amounts to just an operational cost payment. Third, the outstanding litigation against the company stands at 588 crores. If this materializes, it can severely impact the company's financial position. Fourth, the company's contingent liabilities stand at about 594 crores. A contingent liability is a potential financial obligation that may arise depending on the outcome of an uncertain future event. In Meesho's case, much of these liabilities are due to income tax disputes. Fifth, the company has been loss-making since its inception. Its cash flow from operations has again slid into losses in the second half ended September 2025. So, these were some of the key red flags. You can go through the full list of risk factors in Meesho's IPO. Alright, let's now summarize the key findings of this analysis in the concluding section. In this video, we analyze Meesho's IPO from multiple angles. The company's attractive product pricing stems from its asset-light technology-driven model. Further, by not charging its sellers any commission, it incentivizes them to keep prices low for buyers. This translates into a unique proposition for Meesho, which has also resulted in fast growth, both in terms of top line and key performance metrics. Meesho has even reported positive cash flows from operations. Its debt-free balance sheet further strengthens its investment case. Now, as far as valuations are concerned, the IPO appears to be reasonably priced versus the peers. However, all is not well with Meesho. The company operates in a hyper competitive space and faces challenges from established players like Amazon and Flipkart. It needs to do a better job at converting its revenue to profits. Meesho has yet to achieve profitability, and like other startups, this will continue to be a big challenge. The amounts involving contingent liabilities and litigation against the company are quite high and will need to be watched from time to time. Now, given all this, would you apply to Meesho's IPO? Do let us know in the comment section. And that's all I had for you today. I hope you found this video useful, and if you did, please share with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.